Hello again and welcome back.
The next step in a manual system or a computerized system is then to summarize the effect of all of these transactions recorded in some journal or in some area of memory, to summarize those for each individual account, meaning each individual asset, liability, owner's equity. And we do that by posting the journal entries to what is referred to as a general ledger. What is a general ledger? Whether it be in a manual system or a computerized system. A company's general ledger is a file in the memory of a computerized accounting system, or it's a book of accounts, sheets of paper, in a manual system that has a separate record for each kind of asset, liability, or owner's equity account, including revenues, expenses, and dividends. Each of these records is commonly referred to as a separate account within the general ledger. Each account in the general ledger is intended to accumulate the increases and decreases recorded in the journal, producing some kind of a periodic summarizing balance for the account. Now let me show you what I mean in terms of a general ledger. You'll recognize it. In this particular case, we're identifying certain dates of transactions, and we're identifying the debits and credits as they affect the financial position of the company with each transaction. In fact, these should be familiar. I've identified each and every one of the transactions, not for XYZ Corporation, and each and every one of the transactions, all of them, are reflected here in a journal, one by one, in a chronological way. Now, if somebody came to you at the end of June here, these are all the entries during June, and said, "Hey, Stephen, how much cash do you actually have at the end of the month? I mean, how much cash do you have?" Well, I suppose Stephen could, look in his pocket, but usually cash is maintained in some bank account, and, you get your bank statements late. You might not know exactly how much cash you have at a particular point in time. The simplest and easiest way, I suppose, is simply to go to this record, which shows each and every inflow and outflow of cash. So if a person said, "Stephen, how much cash do you have?" Stephen would simply come here and he'd say, "Well, here's cash in of 100. Here's some more cash in of 200. Well, and then some cash went out, 225. And what he'd have to do is actually pull out a calculator and add every single debit or left side entry here to cash and deduct every right side entry. But that can be a little time consuming. The purpose of a general ledger is to separate each kind of asset. In this case, we'll call it cash. The general ledger account for cash might be represented in a manual general ledger with simply a large T on a sheet of paper. And what we're going to do is we're going to simply take each and every entry, whether it was a debit or credit, recorded in the journal, and simply transfer it to this summarizing location, so that we're simply isolating all the transactions that happen to cash, and only the transactions that happen to cash, whether they were increases and decreases. We're simply organizing or summarizing all of the events affecting cash in one location. This is the purpose of the general ledger. It is a record of each individual asset and then the summarization of all transactions that affected it. The process of actually transferring each transaction that affected cash in terms of debits and credits to the summarizing general ledger is called posting to the general ledger. In a manual system, you actually sit there and you do it by hand, which actually isn't very efficient. But we'll do it here. Here's the cash general ledger for Stevens. They had no cash at the beginning of the month because this was the first month of Stevens' operations. There was no existing cash at the start of June. But then Stephen got $100 from himself as an investment from the owner. So what we'll do is we'll simply look at each journal entry as it happens and post it or transfer that amount as a debit or credit. We post $100 from the first transaction, and we'll show that as $100 here. Many times we'll actually make a little tick mark right next in a manual system to note to ourselves that we have posted that to the general ledger so that I don't do it again, do it twice. Well, the next transaction that affected cash was the second one, a $200 increase. And we show that on the general ledger at $200. The next transaction had a credit for $225 when he bought inventory. And so we'll tick that and we'll now place that in the general ledger cash account as a credit. If we did this manually for every transaction, we would end up with all of these entries, and then an ending balance would simply be calculated by adding all of the debits less all of the outflow credits for an ending balance of $170. We would then have to make a separate T account for every single kind of asset, liability, owner's equity, revenue, expense, dividend, and also post those transactions. For example, for inventory, the first transaction that affected inventory on the general ledger was the third one, where we purchased inventory for $225. And again, that would be posted to the general ledger. We would do that for every inflow and outflow of inventory. This is kind of a laborious task in a manual system. But the fact of the matter is most businesses today are computerized. And the general ledger is the place where we have this summarizing and ultimately running total of each kind of asset, liability, and owner's equity account. The next thing I'd like to do is again review the steps of the accounting system as we've progressed, and then add a new step. Steps of the accounting system are first, again, to identify each and every one of the business transactions. Number two, to analyze those transactions and determine the effect on the financial position. Then those transactions are recorded in a journal. And finally, we post those transactions from the journal to a summarizing general ledger. And this is either done manually or in a computerized system electronically. The next step is a step that's exclusive to a manual system. It's called preparing a trial balance. Now, what is a trial balance? A trial balance is simply a listing of all the accounts in the general ledger. Every asset, liability, owner's equity, revenues, expenses, dividends, etc. And noting their ending balance after posting all the journal entries and then calculating an ending running balance. You simply list all of those accounts and then reflect the balance, whether it be a debit or a credit balance. If you do this for all accounts and have properly recorded all transactions and posted them, you will have an equal amount of debits equal to credits. This number is not total assets because, yes, assets, cash, inventory, accounts receivable, will have debit balances, amounts of cash and inventory, but expenses also exist as debit balances. We've had $10 of dividends. Cost of goods sold is an amount of $300. So this is not total assets. It is simply the total of all accounts that have a debit balance. And on the credit side, it is not just all liabilities or even owner's equity. I mean, it's every account that has a credit balance and simply the total. The reason why this is useful is that it tells us immediately whether we have made a mistake. Because ultimately, if every transaction has equal debits and equal credits, and we have posted those accurately, debits and credits to the general ledger, then the balances in those general ledger should be balances which have equal debits and equal credits. By the way, that is all a trial balance does, is it tells us that we have an equal amount of debits and an equal amount of credits. Unfortunately, the trial balance really doesn't give us assurance that we have accounted for every single transaction properly, or that we've even accounted for every single transaction. For example, if we simply missed a day's worth of transactions, our trial balance will still balance. We will have an equal amount of debits and an equal amount of credits. We simply will not have the amounts of debits and credits in each of the accounts for a day's worth of transactions. If all the transactions we did record had equal debits and credits and were posted, this trial balance will balance, but our amounts will not be accurate. All a trial balance tells you is that you had equal debits and equal credits. Which really gets me to a point. This is the purpose of establishing the rule that every transaction must have equal debits and credits. It is simply a way to do some self-checking in terms of accurate accounting. If every transaction is required to have equal debits and equal credits, it is easy to identify a transaction that has not been properly recorded. Because if in fact the debits don't equal the credits, we know we've got a problem and that we have not accounted for it properly. Now again, we may make an entry that has equal debits and credits, but made them to the wrong accounts. So having equal debits and credits doesn't mean that you have accurately recorded every single transaction. But it is a way to check whether or not a certain element of recording a transaction has been done properly. There must always be equal debits and credits.